Today on your Finance and Economy Today, where we review facts, data, insights, and how it affects you. The Buffett indicator just hit 230%, the highest level in recorded history, and in the next 12 minutes we are going to break down exactly what that number means, how we got here, and what it means for your money. Warren Buffett once called it the best single measure of whether the stock market is overvalued or undervalued. It is a single ratio, one number, and right now that number just hit a new all-time high, 230%, higher than the dot-com bubble, higher than the 2021 peak that Buffett himself called playing with fire. In this video, we break down exactly what this indicator is, how we got here, and what history shows happens when it gets this high. Let us start with the numbers. Let us start with where we are today. The Buffett indicator sits at 230% as of June 2026. That is a new all-time high, and it matters because of what the number actually means. Here is the simple math. Total U.S. stock market capitalization, meaning the combined value of every publicly traded company in America, is currently about $60 trillion. U.S. gross domestic product, or GDP, meaning the total value of all goods and services the U.S. economy produces in a year, is about $26 trillion. 60 divided by 26 gives you roughly 230%. When this ratio is at 100%, the market is worth about as much as the entire economy produces in a year. That is considered roughly fair value. When it goes above 100%, stocks are getting expensive relative to the real economy. When it drops below, they are cheap. Now look at the history. The dot-com bubble peaked at 148% in 1999. Then the market fell roughly 50% over the next 2 years. The financial crisis in 2008 brought the ratio all the way down to 66%, the cheapest stocks had been in decades. The market then recovered and climbed. By 2021, the ratio hit 207%. The previous all-time high, and Buffett publicly warned that anything approaching 200% was, in his words, playing with fire. The market then dropped 19% in 2022. Today, at 230%, we are 23 percentage points above that 2021 warning level. But to understand just how extreme 230% is, we need to see where this number has been over the last 30 years. To understand how extraordinary 230% is, you need to see the full journey. In 1995, the ratio was just 72%. Stocks were modestly valued relative to the economy. Then the internet boom hit. By 1997, it had crossed 100% for the first time ever, meaning the market was now worth more than the whole economy produced in a year. It kept climbing. By 1998, it reached 139%, and in 1999, it peaked at 148%, as investors poured money into dot-com companies with no earnings and billion-dollar valuations. Then reality arrived. The Nasdaq fell 78% from its peak. The broader market fell roughly 50%. By 2002, the indicator had crashed back to 78%. That is what 148% got you. The next decade was relatively calm. The ratio hovered between 90 and 133% through most of the 2000s and early 2010s. Briefly dipping to 66% during the 2008 financial crisis. The recovery from 2009 was slow but steady. By 2019, the ratio reached 152%, higher than the dot-com peak on its own. Then the pandemic hit, the Fed cut rates to near zero, Congress sent trillions in stimulus, and markets took off. By the end of 2020, the ratio was 184%. By 2021, it hit 207%. The Fed then started raising rates aggressively in 2022. Markets fell. The indicator dropped back to 148% by year-end. But then markets recovered fast. 167 in 2023, 190 in 2024, 205 in 2025, and now in June 2026, 230%. Every prior time this ratio crossed 150%, a meaningful correction followed. At 200%, the only precedent is 2021, and that was followed by a 19% drop in 2022. So what is actually pushing this indicator to record highs? So how did we get to 230%? There are four main forces pushing this ratio higher, and they all interact with each other. The first is passive index investing. Over the last 15 years, trillions of dollars have shifted out of actively managed funds, where a human picks individual stocks, and into passive index funds, where money automatically flows into every stock in the index weighted by size. The S&P 500, which is the 500 largest U.S. companies, now has over $10 trillion tracking it. Every paycheck deposited into a 401k, a large portion flows automatically into index funds, which automatically buys more of the biggest companies. The bigger the company gets, the more money flows in. The second force is concentration. The top 7 technology companies, often called the Magnificent Seven, including Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and Tesla, now make up more than 30% of the entire S&P 500 by market value. Their combined market cap exceeds $20 trillion. A decade ago, no 7 companies came close to that kind of dominance. The third force is corporate buybacks. American companies have spent roughly $9 trillion buying back their own shares since 2010. When a company buys back shares, it reduces the number of shares outstanding, which pushes the stock price higher even if earnings stay flat. Buybacks artificially inflate market cap without the underlying economy growing to match. The fourth force is the AI investment boom. Since 2023, markets have repriced tech companies based on expectations of enormous future profits from artificial intelligence. Nvidia alone went from a market cap of roughly $300 billion in 2022 to over $3 trillion in 2025, a tenfold increase in 3 years. That is not GDP growth. That is a valuation reset at a scale that moves the entire ratio. Here is how Washington and the Federal Reserve are responding or not responding to record valuations. Now, what has policy done about this? And what is the smartest investor in the world actually doing with his own money? Starting in March 2022, the Federal Reserve began the fastest series of interest rate hikes in 40 years. They raised the federal funds rate from near zero to 5.25% by July 2023. The idea was straightforward. Higher rates make bonds more attractive relative to stocks, which should pull money out of equities and cool valuations. And it worked briefly. Markets fell 19% in 2022, and the indicator dropped from 207% back to 148%. But then inflation cooled, the Fed paused and began cutting rates in late 2024, and markets surged again. As of June 2026, the federal funds rate sits at roughly 4.25 to 4.5%, still elevated by historical standards, but markets have pushed through it. Now look at what Warren Buffett is actually doing. Berkshire Hathaway, his company, has been a net seller of stocks for 8 consecutive quarters as of early 2026. That means for 2 straight years, Berkshire sold more equities than it bought. Berkshire's cash and treasury bill holdings hit a record $334 billion at the end of 2024. That is not a typo. $334 billion sitting in cash and short-term government bonds, earning interest rather than being deployed into stocks. Buffett has not publicly said the market is going to crash. What he has done is act. He sold large portions of his Apple stake, his largest holding, reducing it by roughly 60% over 2023 and 2024. He has publicly stated he is happy to hold cash when he cannot find stocks at attractive prices. At 230% on the Buffett indicator, he apparently cannot find attractive prices. Now, what does a Buffett indicator at 230% actually mean for you? So what does this actually mean for a regular person with a 401k or a brokerage account? Let us start with what the data shows, not predictions, just history. The 2 times the Buffett indicator crossed 150% and kept climbing, here is what followed. In 1999 at 148%, the S&P 500 fell 49% over the next 2.5 years. In 2021 at 207%, the S&P 500 fell 19% over the next 12 months before recovering. We are now at 230%. We do not know what comes next. Nobody does. But here is the math on a potential correction, just so you understand the scale. The average American 401k balance as of early 2026 is approximately $120,000, according to Fidelity data. If markets fell 20% from current levels, that average balance drops to about $96,000, a loss of roughly $24,000. A 30% drop brings it to about $84,000, a loss of $36,000. That is real money. That said, 401k investors who do not sell during a downturn historically recover those losses as markets eventually rebound. The people most exposed are those approaching retirement who cannot wait out a 5-year recovery. Check the Buffett indicator quarterly. It is one of many data points worth watching, alongside price-to-earnings ratios, corporate debt levels, and earnings growth. The Buffett indicator is at 230%. That is not a prediction of what happens next. It is a data point, one of the most historically reliable measures of market valuation ever constructed, and it is now higher than it has ever been in recorded history. Whether you check it monthly, quarterly, or just once a year, it is worth knowing. Do you track this indicator? Drop your number in the comments. If this was useful, hit subscribe. We cover one economic data story at a time, just the facts.